Hi everyone, welcome to the Personal Finance Playbook. I'm your host, Jack Wang of Longhorn Financial. Today's topic is one of those things that we all hate to pay for, but we're all so glad that when we have it, when we actually need it. What am I talking about? Insurance. Home, auto, umbrella, and other types of property and casualty insurance is usually required by law or required by a loan, but they serve a very basic purpose, to protect us from major losses. And thank goodness, because as I'm sure you know, auto accidents and things are quite common and can be very costly. To offer tips on these types of insurance is Jared Lowe of Bearing Star Insurance in Methuen, Massachusetts. Thanks for being on the show today with me, Jared.
Thanks for having me.
Thank you. Let's get right into it. So home and auto, right? So usually not something people think about except for cost. So let me ask you, what are some of the most important things that people should pay attention to when considering an auto insurance policy?
So you're right. The first thing that people usually hit is cost. That's all they usually think about because that's what they see. They have that monthly payment coming out of their bank account, or they might actually be, sending a check. But it is important to take a step back. And so the first things that I look at when I'm looking at a car insurance policy that I want people to be aware of, number one, and probably the part that people think about least, is your liability coverage.
And liability is when you hit someone else, right?
Yes, it's so when you cause injury to someone else or damage to someone else's property.
Okay.
So what people might not realize is that, let's say, for example, every state has minimum required limits. So there is an amount where you can't buy less than. So in Massachusetts, it's $20,000 per person, $40,000 per incident of bodily injury liability. So that's if you hurt someone, if you cause injury to someone else, and they have medical costs or just costs associated with that. It's 20. The state limit is the minimum is $20,000 per person and $40,000 per incident. And the state minimum for property damage liability. So if you damage someone else's car or fence or house or anything else you might hit, the minimum is $5,000.
Wow.
I've run into people who owned multiple properties, who had a fairly large number of assets, who had only $5,000 worth of coverage for property damage if they had somebody else's car. So you want to make sure that those limits are something that's appropriate, and those state minimums are really never appropriate. They're really never enough.
Right, right. Yeah, it sounds really low. I mean, and I don't know about the claims, but I can imagine on the personal side, $20,000 a person. Think about medical costs these days. You go through it like that.
Yeah, that could be a couple days in the hospital. It's very. So people should spend some time making sure that they have solid liability limits, because if you just take the cheapest thing, you're not going to have appropriate limits on the liability side. The other part, there's a couple other important parts. There's medical payments coverage, which is a big deal. What that does is it covers you yourself or anybody who's in your car in the case of an accident. It's first dollar coverage, which means it kicks in before your health insurance policy. Let's say you have a health insurance policy with a high deductible, which a lot of us do now. Yep. You might have a $5,000 individual deductible, or higher on your health insurance policy. Your car insurance policy can kick in and help you before you get, so that you're not coming out of pocket on injury from a car accident.
Okay. But that's the liability coverage. Now, I know on auto policies, there's a couple sections. There's liability, of course, which you just talked about. But then there's also collision.
Yep.
And then there's comprehensive, and comprehensive, all I ever think about is auto glass.
Yep.
So share with our viewers just a little bit around those sections, sort of what they do and any tips for those.
So collision is just what it sounds like. It's if you're in an accident with another car or stationary object, and your car insurance policy is footing the bill, then it will be under collision. So this is going to be where no one else is at fault and your insurance company doesn't have anybody else to go after.
Okay.
It's going to come out of your collision coverage. Comprehensive, you'll actually see that called sometimes on a policy declarations page. You'll see it called other than collision.
Okay.
Because it's kind of a catch-all. It's if you're in an accident, so it might be an accident that's actually one of the ones that surprises people is if you're in an accident that's caused by an animal, a deer jumps out in front of you, that goes under comprehensive coverage. But you hear it called fire, theft, and vandalism coverage. It's damage to your car from things that are outside of your control.
Okay.
Is kind of the overriding concept. It does include your auto glass coverage, which is the one that most people use most often.
Right. Right.
If somebody kicks up a rock and it takes out your windshield, that coverage for that is under comprehensive.
Yeah, actually, I just got my auto glass windshield replaced a few weeks ago.
Yeah.
All right, so these days, and I can remember back when you didn't see all the advertisements on TV that you see these days, and I got to hand it to a lot of these companies. They're pretty entertaining now.
Yes.
But they talk about different things that I don't think was ever there before. And again, you're the expert, I'm not, but things like disappearing deductibles and accident forgiveness. And so to me, as a layperson, they seem to be relatively new. So share with our viewers a little bit sort of what those are and sort of how they work briefly.
Yeah. So what those are is they're ways to customize your policy. And so this is a product of competition. As companies try to attract customers, they want to offer stuff that people like, that people think they want. And there are extras. Your baseline coverages. We talked about a couple of them. Uninsured motorist coverages. Those are baseline coverages. But things like accident forgiveness. Is usually something that is added. Some companies are including it, on the baseline policy now for some customers. Disappearing deductible or decreasing deductible. That's a type of coverage where you may select a $500 deductible on your car insurance, but year over year, if you don't use your car insurance, if you don't have to make a collision claim, your collision deductible goes down by $100 every year.
Okay.
Which is a great idea, but you will be paying for that coverage. So, and it will be anywhere between $20 to $50 a year typically. Okay. So you want to, the real question when you're looking at those extra coverages is this important to me?
Yeah, sure.
Is it do I mind just having a $500 deductible? If I don't mind just having a $500 deductible, I don't need the decreasing deductible.
Right.
A big one that's really helpful for a lot of people that I usually recommend is new car replacement. So what happens there is you buy a new car, and this is a finance show, so maybe you've talked about this before. You buy a new car, you drive it off the lot, and the value decreases
right away,
dramatically.
Right away.
So that used to leave people with a real problem if they got into a car accident within, say, the first year of their after buying the car, because what your car insurance policy is designed to pay you what your car is worth, which is great. That's how it should work. Except your car is worth. The difference between what it would cost you to buy a new car and what your car is worth are pretty dramatically different during that first year.
Right.
So this is a coverage that a lot of companies offer now, and where you can, it'll usually have stipulations. So it's if you're in an accident, if your car is a total loss within the first year, typically, and within the first, say, 12,000 miles or 15,000 miles. So that's when the depreciation is hitting you the hardest.
Sure. Right.
So in that first year when the depreciation is hitting you the hardest, if you get into an accident, your insurance company will just pay for the cost of a new car. And I mean, that's a big one. That matters if you're buying a new car.
Right, right.
That could be a value of several $1,000s, depending on the vehicle. Now, if you don't buy new cars, or if you don't have a new car, then you don't need new car replacement.
Right, exactly.
But for folks who do buy new cars, it's a big deal.
Right, right. So, you mentioned deductibles. So let me ask your opinion on this. And I've heard it, any number of ways. I'm sure you go on the internet, you see any number of articles on this, right? Some people say, let's go with a really high deductible so we get the monthly payment down or the overall cost down. Other people say, go with a lower deductible. Yeah, it's higher cost, but it's less out of pocket if you get into an accident, right? What's your personal opinion on this?
Right, so both of those things that you just said are true. You can save money by taking a high deductible, and it's also nice and convenient to have a low deductible if you get into an accident. So there are a couple of guidelines that I recommend when you're picking out your deductible. Number one is you shouldn't have a deductible for more than you can pay.
Right.
If you don't have $1,000, don't have $1,000 car insurance deductible.
Right.
Now, hopefully, you got $1,000, but a lot of people don't on a day-to-day basis.
Unfortunately, true.
And they don't, or they don't have it readily accessible. The way I feel is that your deductible should be an amount that would make you roll your eyes or groan a little bit if you had to pay it, but it shouldn't put you under financial stress.
Yeah.
You shouldn't have to dip into savings to pay your car insurance deductible if something happens. Now, and that's all in the construct of car insurance. If you move over to homeowners insurance, the same principle applies, but the numbers get a little bigger. So homeowners insurance is a kind of a catastrophic loss policy.
Right, sure.
Hopefully, if you own a home, you do have a few $1,000s in the bank.
Right.
And your starting point whereas your starting point for a car insurance deductible could be as low as $100. Most people are somewhere in the $500 range, and some people are in the $1,000 range. Your starting point for a homeowner's insurance deductible is typically about $1,000.
Okay. So sticking on auto insurance, and we'll talk about this again later when we get to homeowners. So these days, of course, right, with technology and smartphones and apps, a lot of people are doing these side gigs, much like Uber and Lyft, right? So they're using their personal cars to essentially be like a taxi, you drive strangers around, give rides to strangers. What are some things that people need to think about if they choose to take on a service like that?
Sure. So from the insurance perspective, driving people around for money is something that is excluded from every personal car insurance policy as a standard. So if you get into an accident while you are driving your car for hire, and the old language is livery service. That's what
sure.
You'll see that language on car insurance policies sometimes. It's like a taxi. That's if you get into an accident while you're doing that, you're not going to be covered by your personal car insurance policy on the baseline.
Okay.
So the interesting thing is, as the market changes, as ride sharing becomes, incredibly prevalent, your insurance policy, your personal insurance companies have started to adapt a little bit. Now, what you're still going to find is that companies like Uber and Lyft, they have an insurance policy that applies to you while you're driving.
Okay.
So it's not as extensive typically as most personal car insurance policies are. So you might be on the hook for a little more. Your deductible is probably pretty high on the Uber policy. The liability might not be what I would like it to be on the Uber policy because driving somebody around for money puts you right on the hook if something happens.
Right.
They're coming after you.
Right. Exactly.
If they're hurt in a car accident. But so some companies are adapting. Some companies will still cancel you. They will outright cancel your car insurance policy if they learn that you're driving for Uber, because they just don't want anything to do with that risk. Some companies will just say, okay, you can drive for Uber, but just so you know, as soon as you turn on that app,
Yeah.
you are not covered under
Right.
your own car insurance
Right.
policy. Not when you pick up a driver, but as soon as you turn on the app
Yeah.
to say that you're waiting for a ride, you're no longer covered by us. And then some companies are now adding endorsements. So what an endorsement is, it's an extra feature that you can add to your policy, like what we were talking about with
Sure.
new car replacement.
Yep.
And what they're doing is they're offering a ride share or a transportation network company, that's the technical terminology, endorsement, so that you can have some coverage extending from your personal policy while you're driving, or or while you have the app on, but until you pick up a driver, because that used to be a gray area where nobody was sure if they were going to cover you.
Right.
So different companies are adapting different ways, but you should definitely know. You should check with your car insurance provider, because before you start driving, before you pick up the first customer, you might call them and present it as a hypothetical. So,
Right, exactly.
don't call them while you have somebody in the car. Present it as a hypothetical. So if I'm thinking about driving Uber, will you guys cover me while I'm driving Uber? And the answer will be no, or we won't right now, but you can add something to your policy. You'll pay a little extra, but it'll totally be worth it.
Right. Okay.
And you may need to shop around.
Okay.
To find the right company.
So let's switch gears a little bit. So auto insurance. So now let's talk a little about homeowners. So as you said, the numbers start at a much higher level because there's bigger dollars involved, right? Most of us don't drive $400,000 cars, but you might live in a $400,000 house. So typically, with auto insurance, I think, you determine the level of coverage, like you talked about, what the liability is. But what about the level of coverage with homeowners? Because I know there's a couple of different ways to measure it. So can you just talk a little bit about that?
Yeah, the biggest thing you want to make sure of is that your home, so just talking about the house itself, the structure itself, you want to make sure that it is insured to 100% of what's called estimated replacement cost. Whether or not you cover the exact amount of your mortgage is completely immaterial to having the right amount of homeowners insurance. It's not just that you need to have enough to cover your loan, for instance, which is a question that I get a lot. Well, I need enough to cover my mortgage. Well, sort of.
Right.
That's not really the operative question. What you want is enough coverage to rebuild your house completely if something were to happen to it. If it were to be a total loss, if there were a fire were to ruin your house, and we had to rebuild it totally, you want enough coverage to replace it. So you want to insure to 100% of estimated replacement cost.
And so, so when I would imagine that most people, when you say that term, they're thinking market value of the house, right? So if I bought my house for $300,000, my estimated replacement cost is $300,000.
Right.
But it's not really quite that way, is it?
It's really not. So there are a lot of things that factor in to real estate value. And the structure itself is only one of those things. You have property that's probably attached. You have location. Which community you're buying in affects the price a lot. How much it costs to physically rebuild your house is really kind of a separate question that deserves a separate evaluation. And all homeowners insurance companies have a means to measure that. It's software, really, where your insurance agent should ask you a lot of questions about your house, or gather a lot of information about your house from you and from public records, and about how your house is built, the style of how, is it a colonial or is it a ranch?
Right.
You have wood siding, do you have vinyl siding? What's the roof? Is it your basic asphalt shingles, or did you put on a nice metal roof, or is it the 40-year shingles?
Yeah.
Have you upgraded your bathroom? Have you upgraded your kitchen to a nice quartz countertops, or is it just the builder grade stuff? It's whatever was there when the house was first built.
Yep.
It could be Formica, right? You don't see that a ton anymore, but with older houses, you definitely
But you
do.
never know.
Absolutely. So all those things are important. and all that, that those are the kind of things that go into determining the estimated replacement cost.
Okay. So, that makes sense because as people upgrade their kitchens and bathrooms and they upgrade the materials, that means that they might need to kind of adjust that value a little bit, right,
Yeah,
on their homeowners.
absolutely.
So, on auto, we talked about different, features of auto policy. What are some of the features that people need to watch out for on a homeowner's policy?
Right. So, a homeowner's policy, while technically you could say it's more complicated than a car insurance policy, it's covering more stuff. But the good news is most of the values are you have an automatic baseline to go from. So what happens is, let's say we determine that it's going to cost $300,000 to replace the structure of your house.
Yep.
Well, then the amount of coverage that you have for your personal property, which is everything that you own, whether it's in the house or not, that's going to be determined just as a percentage of that first coverage. So it'll automatically be 70% or 50% or somewhere in the middle, depending on the company that you're using and the package that you're buying, of your estimated replacement cost for the structure. And those built-in levels, especially if you're buying a good homeowner's insurance policy, are usually more than enough for most people. If you have a $300,000 house and you have 75% of that, so $225,000 roughly of personal property, you've probably got enough personal property coverage.
Right.
The big thing that's really important is on the personal property coverage is to make sure that as well has replacement cost coverage. I still see homeowners insurance policies that have actual cash value for your personal property occasionally.
Yep.
And when I'm evaluating people's policies, there's a big problem with that. Let's say you have a nice living room suite, just as an example, and a nice leather, couch and chair and love seat, and it happens to be 8 years old. If something happens, you have a fire and those items are damaged in the fire, you don't want the actual cash value of an 8-year-old living room suite.
Right, exactly. Exactly. You're not going to get much for that.
You're not going to get much.
Yep.
You might get a couple $100.
Right.
You need the couple $1,000 anyway to go replace that, to go buy new ones.
Right.
So you really want to make sure that you have replacement costs for your personal property. Then there's you'll run into, there's several different coverages that are determined. You have coverage for different structures that aren't attached to your house that's automatically built in the policy, your detached garage or storage sheds or stuff like that. You'll have coverage for loss of use. So if you can't live in your house because of an event that's covered and your house is being rebuilt, your homeowner's policy is going to pay for your extra costs. Because you're going to have to stay in a hotel.
Right.
Or you might have to rent a place for a couple months, or might rent a house for a couple months.
Right.
You have coverage for that built into the homeowner's policy. But then the big shift after that is to liability coverages. And then similar concerns to what we talked about on the car insurance, making sure that you have enough, a reasonable level of personal liability coverage.
Right. So let me ask you, we talked about this on auto, but let's switch to home. So again, side gig, apps, everything these days, Airbnb is really popular. People rent out a bedroom, rent out their home while they're gone for the week, things like that. From an insurance perspective, what should people watch out for?
So most homeowners insurance policies have exclusions for damage that happens in your home or liability that you incur in your home due to Airbnb, due to paying guests.
Right.
And that's the operative word, it's paying guests. And that's the thing with Airbnb. It's not like you're just having somebody over. Someone is paying you for the service of being able to stay in your home.
Right.
So I actually just got an email from one of my carriers that I use saying that they are going to specifically exclude, there's going to be new language in their homeowners policies this year that specifically excludes coverage for claims that arise out of Airbnb operation. On the other hand, I have a homeowners insurance company that has what's called a bed and breakfast endorsement. And it's a New England company, so this may be a byproduct of living in New England where there's bed and breakfast everywhere.
Sure.
And people, there's a tradition almost of people renting out rooms.
Right.
Right. But it's an endorsement. You add it onto your homeowner's insurance policy for a couple $100s a year, and it does provide you liability coverage. And it does provide coverage even for some of the damages that might happen from people staying in your house. So it's important to ask the question. Again, just like on the car insurance, it's important to ask the question because some homeowners insurance companies will non-renew your policy if they realize that you're doing Airbnb.
Right, and actually, as I'm thinking, if you don't have homeowner insurance, a lot of times that's a condition of the mortgage. So if you don't have the homeowners active, they call the loan. I mean, whatever happens with the mortgage. So we have a little bit of time left. So let me ask you, Jared. One thing that people always want to know is sort of how to get the best deal, right? So of course, people can go on the internet, do their own research. Lots of resources out there. I know we were talking about that off camera a little bit, but your opinion, what's a good tip to sort of help people get the best deal, and maybe one other final tip separate from price that people should know about their policies or whatever?
Sure. So on getting the best deal, you have to remember that different insurance companies are looking for different customers. Every insurance company, as they're determining their prices, stirs all the risk factors together to come up with their rate. And different companies rate each factor differently. So some companies really care, like on homeowners insurance, some companies really care about your consumer report. You get a big discount if you have a good consumer report. And for some companies, you won't even be able to get coverage if you have a really terrible consumer report.
Right.
Some companies just have a baseline. Like if your consumer report is past a certain level, fine, you're in. It's pass fail. So it's important. So you check with some of the big companies. That's fine. Check with an agency that has companies that you can't buy from directly, and get a variety of quotes. It's really some companies will have discounts for where you went to school, for your alumni association. Some companies will have discounts based on where you work or charitable organizations that you've donated to. And then a big one, of course, is what we typically call bundling. So having your car insurance and homeowners insurance with the same company typically is going to get you a better deal.
Good. Okay.
Yeah.
Very good. Thank you so much. Thank you. And so thank you so much for joining us today, viewers, on this episode of Personal Finance Playbook. So many times people go out and they buy a house, they buy a new car. The insurance so often is the afterthought, right? But as I hope that my special guest today, Jared, has sort of shared, that it's important to think about this to make sure that you're protected, have the right coverage, get the best deal. Many thanks to Jared Lowe of Bearing Star Insurance out of Methuen, Massachusetts. So thanks for joining us today, and stay tuned for the next when we take another topic from the Personal Finance Playbook. Have a great day.